Hello, and welcome to the latest episode of Legal Bites, the official podcast of Cummings and Cummings Law, where we focus on helping entrepreneurs and high net worth individuals to create, grow, and protect their wealth. Today, we are revisiting the so called 83B election and the top 5 considerations when making that election. But first, a brief introduction. My name is Chad Cummings, and I am an attorney and certified public accountant, serving clients in matters of business, tax, and commercial law. I am Chief Executive Officer of the multi-state, multi-attorney law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, as well as a bachelor's degree in accounting and a master's degree in taxation, in addition to 11 professional licenses and certifications covering accounting, tax, audit, and of course, the law. My firm website is www.cummings.law. Consideration number 1, or I should say benefit number 1. You lock in the tax basis at the current fair market value. All of those words have very specific meanings. When you file an 83B election within 30 days of the grant of property, and we're usually talking about shares of stock or membership units, subject to a substantial risk of forfeiture, which normally means there is a vesting schedule, you recognize ordinary income on the value of that property at the time of grant, which is usually very low, not at the time of vesting, according to Internal Revenue Code Section 83B1. To use an example, if the property is worth $1,000 at grant and $1 million at vesting, the election means you paid ordinary income taxes on $1,000. Without the election, you pay ordinary income tax on $1 million. The entire difference between the grant date value and the vesting date value is treated as ordinary income if you did not file. Remember, capital gains rates are lower, 15 to 20%. Ordinary income rates can be over 40% when you factor in the net investment income tax. With the 83B election, you paid ordinary income on $1,000, and the remaining $999,000 is locked in and taxed at capital gains rates, which are lower when you sell. What this means is that the 83B election converts future ordinary income into capital gain. The rate differential, which is enormous, is the single largest benefit of the 83B election. Benefit number 2, you start the capital gains holding period. This is a big one. You start the capital gains holding period at the date of grant, not the date of vesting. In other words, you can sell sooner and pay less in taxes. Long-term capital gains treatment requires a holding period of greater than 1 year, according to Internal Revenue Code Section 1222, subsection 3. Without an 83B election, the holding period does not begin until the property vests, meaning you're waiting longer to sell at preferred rates. With the election, the holding period begins at the date of the transfer. If you receive restricted stock that vests over 4 years and sell immediately after vesting, you have a long-term capital gain with the election and a short-term capital gain, which can be taxed at greater than 40% without it. The holding period advantage applies regardless of whether the underlying property appreciates. Benefit number 3, you eliminate the uncertainty of future tax rates. This is another biggie. Tax returns change, tax rates change. The rate at which ordinary income is taxed 4 years from now is not known today. Anybody who tells you, oh, it's going to be the same, they don't know what they're talking about. Please get better advice. Filing the election fixes the taxable event at today's rates on today's value, eliminating that ambiguity. If rates increase before vesting, and there's a possibility that they will, you will have already paid tax at the lower rate. If the value of the property increases before vesting, you have already paid tax on that lower value. The election removes 2 variables from the equation: future rates and future value. Benefit number 4, you simplify the tax treatment of LLC and partnership interests. When a service provider, which again could be an employee or an independent contractor, receives a profits interest or a capital interest in an LLC or a partnership, the tax treatment at vesting can be very complex, particularly where the interest has appreciated and the partnership holds assets with built-in gain. Revenue Procedures 93-27 and 2001-43 provide safe harbor treatment for certain profits interests, but a capital interest subject to vesting does not receive safe harbor treatment. Therefore, filing an 83B election on a granted LLC or a partnership interest subject to forfeiture conditions fixes the income recognition at the grant date, avoids, or I should say possibly avoids, the complexity of valuing the interest at each vesting tranche, and starts the holding period for purposes of long-term capital gains treatment. Finally, benefit number 5, you control the timing, not the IRS. Without the election, the IRS decides when you recognize income, and the answer is at vesting, which you probably don't control. Remember, a board can accelerate vesting. A change of control can trigger vesting. A modification to the vesting schedule can trigger a new measurement paradigm. Each of these events creates a possible taxable event that the recipient did not choose. Whereas the 83B election, when the property is properly elected to be subject to that election, takes timing off the table and puts you in control. The taxable event occurs at the grant. Everything after that is capital appreciation. Now remember, as I've explained in earlier presentations, the 83B election timeline is unforgiving and brutal. The 83B election must be filed with the Federal Internal Revenue Service within 30 calendar days, not 30 business days, not 1 month, not when you get around to it. 30 calendar days of the grant date, which means if you only find out about the grant a couple of weeks after the fact, after the board makes the decision, you may have only a few days to make the decision and actually file the election. All of this is governed by Internal Revenue Code Section 83B2. There is no extension, there is no exception, there is no late filing, and the election is irrevocable once filed, except with the expressed consent of the commissioner, according to Treasury Regulation Section 1.83-2F. The decision to file requires an intricate tax analysis specific to the facts, including the current value, the expected future value, and the probability of forfeiture. All of those are key variables, not to mention the taxpayer's liquidity. This is not a decision to make based on what Claude or Grok or GPT tells you. You need to work with your existing tax professional to make that decision and then decide whether to file the election. If you are ready to file your 83B election, check the link in the description. Remember, time is of the essence, and we've made the process seamless so it can be completed in under 5 minutes on my website. Again, my name is Chad Cummings, and I hope that you found this information informative. As always, the information in this presentation is necessarily general in nature and is not legal or tax advice, nor should it be construed as such, because that advice definitionally must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my many earlier presentations on this topic, please visit my firm website at www.cummings.law, not .com, but .law to schedule time for a consultation. I look forward to that opportunity to speak and perhaps even work with you very soon.